markets, it wasn't really bad a day, considering we had a quiet start once again, like Monday, but then we picked up from there, and for the better part of yesterday's trading session, we managed to hold on to a good 0.5% gain. And more importantly, it's the banks which really came to the rescue, the lagging part of the market. So that really was the heartening sign. Of course, this morning, things are a lot more different. US indices have managed to snap that 8-day winning streak. Treasury yields have seen a bit of a slide coming in. You've got some softening coming in for the dollar. While gold continues to be at a record high, it's dollar which is at a one-year low. And more importantly, after Wall Street faltering, Asia as well seems to be picking up the same sentiment, because Japan trade has now swung into deficit, and there are fresh concerns with regards to the yen movement as well. So the trade gap over there has definitely widened, and you are seeing a sea of red all across the Asian screen as well. So not the best of handovers, Nikuj, when it comes to at least from the global markets. I don't know whether we are going to choose to follow the global markets today though or not.
Yeah, you have to realize that it's been a 8-day vertical gain for global markets, and after that little bit of chop and churn, some amount of profit booking is something which is par for course. So I don't think from a global market standpoint you could say that there is a cross which Indian markets will have to carry today. That really may not be at play. I think frankly for Indian markets there are more than, I would look at the market in two ways. One, from the prism of benchmark indices. And if you look at benchmark indices, that really needs to be a global connect rather than a local connect. If benchmark indices will continue to chug along well as long as there is global strength, which I think is undeniably very strong, the brute force of liquidity both locally and globally is so strong that bulls cannot put a foot wrong. But the minute you start going down and you start talking about sectors, themes, which is what we'll talk about, the market is getting now very divided. The market is getting very, very differentiated in terms of what is going up and what is going down. So that is the market which you really need to focus on, because judging the Nifty, I think it's easy. That is a function of global strength. But judging where money within sectors is moving and where money is moving out, I think that is something which needs some debating, and that is something which really needs some amount of thought.
In fact, yesterday's market, the first 15-20 minutes of the trade is where the lowest point of the day was actually made, and after that it was a trend day, one-sided. The highlight of the trade, which Aisha spoke about, was the financial banking is coming back. Nikunj, do you think that from here on, in fact yesterday Bank Nifty made a high of above 51,000 in intraday, came back a little bit, but still after a long time, is that reversal happening? Yesterday we said, this was the only area which was frowning. Is that reversing now? Yesterday looking at the banks.
Within banks, you look at PSU banks. PSU banks did much better than private banks. Now is money moving out of the shipping and the railways and the defense stocks, and is it moving back into private banks? The answer to that may well be a yes. Similarly, apart from banking, life insurance stocks yesterday had a field day. You got new tech or consumer tech companies which are making a comeback. So whether it is underperformance in IT which is getting checked, the outperformance in banking which is getting started, or some of the ranked outperformers of this bull market which is shipping or defense and railways, they are seeing some migration of flows, that really could be at play. See, banking stocks are cheap. That is the only large pocket where you could say banking stock financials, they offer decent value and they have decent growth, and there is no problem in terms of the near-term economic connection in terms of NPA. So I will not be surprised that the subtle outperformance may actually start in banking, given that there is a lot of churn which currently is visible in the market. And this churn, in a sense, see, what will happen is that money is not going to move out of equities. It's just going to rotate, and I think this rotation trade is what we need to catch on. Suddenly autos have hit a pause button and FMCG stocks have starting higher. So there are so many sub themes within the market which is what we need to focus on. But banking, you're right, I think it's more about money moving out of those railways and defense and shipyard companies, and it is moving back into PSU banks.
Yeah, and in fact, talking about those defense and railway, the favorite PSU pack, look at the kind of fall that they've actually seen, not just on a 1-month basis, but even on a weekly basis. We were just looking at the top list of the PSUs which have fallen the most from their 2024 peaks. There's BEML right up there. It's seen a 30% fall, no less, from its peak. Cochin Shipyard, a 28% fall. Engineers India down 28%. Bharat Dynamics down 27%. 7%. RFC, IRCON 21 to 23% respectively. And even in the last 1 week or so, barring a few odd names like HAL, Nikunj, most of them have ebbed off.
So, Aisha, I think, we are just not recognizing it, but if stocks, they've fallen 25 to 30%, that means officially they are in a bear market. If a stock falls more than 20%, anything that falls more than 20%, officially you say that it's in a bear market. So I'm not using the word out loud to say that, okay, PSUs, the bear market has started. But in terms of the context setting here, the context setting here is that the fall actually has been very, very brutal. Variety of factors. And if I just have to name some, rich valuations, very stretched in terms of the P multiples they had started commanding. See, the market is clearly rotating. The market is now looking at businesses which offer perhaps more visible growth in the medium term. See, these are companies which are completely dependent on government capex, and you don't know how government capex in a sense in future is going to grow and move, considering that there are a lot of other compulsions which are now taking over. So variety of factors which are at play right now. I think, while I will not rule out further volatility in some of these stocks, I sincerely feel that it is not the right time to buy, because apart from these over-owned, over-concentrated stocks where liquidity is a large concern, I don't think institutional investors will come back in a hurry at these levels. Whatever NFOs have to happen, they've happened. The sugar rush which happened largely in last 1 month or so, I think because of those 2-3 NFOs which were in the market, that also is behind us. So this is a space you want to keep on your radar, but this is a space which you would say that I would buy perhaps at lower level, or there is more bang for buck in other sectors like new tech, select pharma, some FMCG names, or for that matter, a lot of IT names.
And I think more than that debate about whether to buy these stocks afresh at these levels or not, it's more about whether do you profit take, because most investors out there are sitting on sizable profits, and I'm not talking about the recent spate of NFOs which have just come in wherein you would be sitting on a negative return, but it's more about whether this is a trend in the making, and is it going to get worse from here, and then do you need to capital protect when it comes to the PSU names?
So, Aisha, when these stocks, they go up, the advantage was that they were low in terms of float. So a little bit of buying made a lot of difference. Now on the downside, the reverse is at play, because the float is low, a little bit of selling could actually make a lot of difference. And a lot of these stocks, excepting let's say a HAL or a BL or I think BHEL and BEL, others are not also in the FNO market. So that in a sense is also a factor at play, because large part of the ownership is owned by Government of India and no dilution is coming from this, so liquidity is not increasing. So I think now the technical factors would be at play. And even after the recent fall, you cannot justify some of these stocks saying that, okay, there is value and you need to be a contra. The time to buy fear comes in when there is a very deep value available, or when the selling is being done unnecessary because of technical factors. These stocks were not due, but they were overdue for a fall. And I think a little bit of weight shedding is something which in a sense will really make them healthy. Otherwise, they were running the risk of a melt up. It's like they'd become Humpty Dumpty. And Humpty Dumpty were due for a fall. But when the Humpty Dumpty falls, you put them on the treadmill, they lose some bad fat, they'll be fit again to run. So these are businesses which still have a 5, 7, 10-year wonderful story. But a lot of these stocks had started pricing in like eternity. 80, 90 P multiples, low float, everybody wanted to buy them, everybody wanted to own them. Market is all about buying something which has value. And the word value was just not there. And I don't think it is still there. So you don't want to be a compulsive buyer here. Let's see where technically this stocks they settle.